My name is Stefan Fusi, and I work as the Managing Director for the Center for Entrepreneurship and Innovation at Duke University's Fuqua School of Business. And today I'm joined by Mr. Ram Jani, who is a shareholder at Vedder Price. Vedder Price is a national, really international business law firm with offices all around the US. And Mr. Jani is a member of the firm's corporate practice area in Chicago. Mr. Jani focuses his practice on private equity and venture capital, mergers and acquisitions, investment services, and general corporate advisory work. And he has experience in a wide range of transactions, business ventures, general corporate matters, and has represented a number of well-known private equity funds, search funds, and independent sponsors in leveraged acquisitions, recapitalizations, and exit transitions. We're going to be talking with Mr. Jani today about search funds and how one might engage with legal counsel related to all the things related to search funds. Now, maybe you are wondering, what is a search fund? So we should offer you a bit of definition there. Search fund is essentially an investment vehicle which allows an aspiring entrepreneur the opportunity to search for, acquire, manage, and grow a company. Typically, you hear about search funds related to another term, entrepreneurship through acquisition, or ETA. And so as students at the Fuqua School, you may come across resources that deal with ETA, and so this is part of that series of information. And so, Mr. Jani, welcome, and thank you very much for participating in this conversation with our students and alumni today.
Thanks for having me, Stefan. I'm happy to do it.
All right, very good. Well, let me just jump out and jump in and ask you a couple of questions, just one off the bat, which we hear from just to get us going. So many students and alumni ask about this. They would like to know, at what point does legal counsel get involved with search fund entrepreneurs? Do they call you when they're just getting started? Do they call you when they're nearly done and they found a business? Can you help us give some clarity about what your experience has been and what you advise search fund entrepreneurs to get started?
Yeah, for sure. So the answer is the answer to all of your questions is yes. You know, that's the right time to do it, and that's the time that people do it. So it just depends a little bit. Certain searchers or certain prospective searchers will call me before they've even written one word of a PPM. And a PPM is the private placement memorandum that a traditional search fund will use to go out and raise capital from its from their investors or from its investors. So some will call me before they've done anything. Some will call me and say, "What is a search fund?" That's, I think, less and less the case these days. I think now it's more, you know, people are more inclined to call me. They know what a search fund is. They've started working on their PPM, and they're looking to kind of figure out when is the right time to engage counsel. Is it before you've gone out to raise capital? Is it after you have some capital raised? And I think the lawyer's answer is, and I'm a lawyer, so I'll give you the lawyer's answer. The lawyer's answer is you probably should talk to a lawyer before you go out and raise capital, because it's a securities transaction. And having talked to a lawyer and having had a lawyer review your PPM and having an entity formed before you're out capital raising, you know, probably makes sense. In the real world, do people go out and send their PPM around and have investors look at it prior to engaging a lawyer and prior to having an entity formed? I'm sure they do, and I know that they do. But have I ever seen anybody get you know, in trouble or arrested? You know, of course not. Is it possible that there would be damages? It is possible. There are theoretical damages. So, but at the same time, most of the time, people will get me involved or will have had a conversation around this time. Some people will call me though, you know, hey, I'm 75% of the way through my capital raise. I've got 75% of the commitments. Can you help me just start putting the paperwork together? And I'm happy to do that too. If the investment commitments are there, we can start putting the paperwork together for your search fund, and we can start at that point. And then for non-traditional search funds, so meaning something like a self-funded search, or it could be somebody who's maybe in an accelerator. They could call me when they're further down the road. They could call me at a point where they have a letter of intent they want me to review. They don't want to sign a letter of intent without a lawyer looking at it. That's another checkpoint that people use. Another place is I've signed the LOI. I'm done with quality of earnings. I'm ready to do legal diligence and start negotiating, purchase agreement and other legal documents, definitive agreements. And again, perfectly fine time to get me involved. I mean, at some point, you do need to get the lawyer involved. I think that we can help with efficiency, and then we can kind of help your process go a little bit more smoothly. I think we can probably make you sound a little bit like, a little bit ahead of the game when you're out doing your fundraising at the initial stages. So I think my recommendation would be you get us involved a little bit earlier, but there's no wrong time to call a lawyer.
Okay, thank you for sharing that. There's a lot to unpack in that. And one thing that I know from engaging with several search fund entrepreneurs or searchers is that the nature of doing a search is very hands-on. You're constantly calling prospective acquisition companies and looking for investors and managing a team, etc. Perhaps it could be interns who are helping you to find these companies that you're looking for. And so just how hands-on should a searcher be when engaging with legal counsel in all the areas that you just mentioned, before they start the search, before they have their memorandum going, their PPM, all the stages you talked about? Just how hands-on should they be, and how much should they leave to legal counsel to work through?
So that's an interesting question, and that's a little bit, you go by feel a little bit, and there are certain searchers who are, very much kind of deal people. They're people who have come through this world by being in investment banking, being in private equity, and they're very, very comfortable with the M&A transaction and diligence and kind of how everything works. And they may be more hands-on. They may say, this is kind of how I want this to look, this is how the approach I want to take here, and they may be, have an exact way that they want to do things. Many times though, it's somebody who's a little bit more of an operator. They're not really an M&A person. They didn't come from an M&A professional background, and they will turn to me and just say, on the M&A deal, you just figure out what you want to do, and let's make sure that let's make sure the deal gets done, but I'm not going to micromanage how you're going to run the process. Again, totally fine way to do it. I would say that at the PPM stage, don't expect me to draft your PPM. I'm not going to do it. I kind of refer people to the template PPMs that are available online, or talk to a former searcher or somebody who's searching right now, and they'll send you PPM. Most of the time, people can get a hold of those. What we're going to do when we review your PPM is, we'll look at the legal disclaimers and risk factors, and we'll help you with kind of terms if we think that they're off market. But you're going to do a lot of that work yourself, so you wouldn't lean on us to write your PPM. As far as the legal documents around raising capital, the LLC agreement, the subscription agreement, accredited investor questionnaire, the side letter with indicative terms, you should assume that we're going to write those, cover to cover. We're going to send them to you with a handful of footnotes that we'll want to go through with you, make sure that you understand the documents, make sure that you understand the process, the timeline. The investors understand these documents because they've looked at them 100 times. You, as the searcher, are not going to understand them necessarily, but some people are very facile with the documents. Other people, want to get a tutorial on it, and some people just don't care. Some people just, you're the lawyer. If this is what everybody else's documents say, good enough for me. So again, personal feel, and I'm happy to do whatever. I have had calls where we go through the documents with at this very basic search stage where we'd spend an hour and a half, and we need another half hour or 45 minutes to go through the documents because the searchers want to read every word and understand every word. And I have other ones where we go through the 10 footnotes I put in, and they say, is everything else just what everybody else does? And I say, yeah, basically. And that's good enough for them. So that is a little bit, it's driven by the searcher. I'm happy to spend as much time with a with the searcher as they want, because I think it's important that they're familiar with the documents. So that's kind of at the very early stages. Then, I also will send, when I work with a searcher group, I'll send a toolkit of documents to use if they want to start with our forms. I'll send a letter of intent and some other things like that I think are useful for the searcher. And so, again, trying to give the searchers tools to be able to help themselves and sort of do the work themselves. Because once we start doing the work, of course, we're charging time, and I want to be efficient with searchers' time. So I want to do as much as the searcher wants me to do, but I also want to give the searcher tools to be able to, to basically be able to do some of this work themselves. And then, I can take a look at something that they've done. If they draft an LOI, if they start with my template, it's very easy for me to, spend a little bit of time and help, develop some additional provisions if they want that, or just look at what they've done to see if it makes sense and see if it's basically market, et cetera, when they send it out. So, it can be, and then, when we're doing diligence and when we're negotiating a purchase agreement, there's, again, a ton of interplay. Diligence, the business diligence and the quality of earnings and the IT diligence, all that stuff is getting done, and the searcher's very much doing all of that work. Don't expect me to do that work, but legal diligence, we're obviously going to focus on, and we'll get that done, and we won't need a ton of assistance on legal diligence. And then negotiating, drafting the purchase agreement, again, we'll write the first turn of it. We'll go through it with you, make sure that you understand what's in it. But then it'll go to the other side. And when we're negotiating with the seller, we're going to do a lot of that work, and it's kind of fun. We'll get on the phone before a conference call with the other side when it's going to be, lawyers and clients, and we'll say, okay, who's going to be the good guy, who's going to be the bad guy, and invariably, I end up having to be the bad guy, which is fine, part of my job. And on these ETA deals, by the way, I mean, this isn't like I think in more traditional private equity transactions, I think there's a lot more of the lawyers kind of headbutting and, this provision has to be written this way. And I've never seen it ever done like this in my entire life, and that sort of attitude. And with these ETA deals, it's a lot about just trying to get an M&A deal done. And at the end of the day, the seller wants, $20 million. And at the end of the day, the buyer wants a business that it believes is worth $20 million. We all should be able to get there and do it in a way that's fair, and do it in a way where, at the end of a transaction, we can all go out and have dinner and not at each other's throats. So that's really the spirit, and that's kind of how I work together with clients, and it's very much client driven. I'm happy to do as much as a client wants me to do, and I'm also happy to let them drive to the extent they're comfortable with that.
Thank you. I'm curious, you mentioned about the sellers, just as an aside, have there been any particularly interesting seller sites that you've been on? In the case where the searcher is willing to be more hands-on with you and have you be a deeper part of the due diligence, are there any interesting site visits that you might have done for alongside of a searcher, or do you typically not get involved with that level of due diligence?
Yeah, no, I mean, I have done it, but it's not, nowadays, most of what we do on the legal side is, is kind of reviewing materials and reviewing documents and that sort of thing. But certainly we've gone on site and seen businesses, and these search fund businesses are incredibly diverse. I mean, these are not businesses that are, not everyone is just in an office building somewhere. A number of them are, and again, that's fine. But there have been businesses where, one of the seller's requirements is that if the seller was going to stay on or something, and in the employment agreement, the person had to be allowed to bring their dog to work. And it's just kind of so it's like little things like that are kind of comical that are only in an ETA type of transaction, right? That kind of stuff on these bigger deals that are more professionalized or institution to institution type transactions. There's less of that kind of personality or just the sort of small items of comedy that keep some of us going. But for sure, there's interesting things on every deal, and we've I've negotiated with on one deal I negotiated with a lawyer who was I mean, he literally was doing a residential real estate closing in the morning, and then had an estate planning meeting in the middle of the day, and then we were doing a closing call in the afternoon for an M&A deal, and and it was just which I found, I was like, wow, it's incredible. And my client was like, oh, this person doesn't know what he's doing. I'm like, no. This person is incredible. Like, there's no way I could do. I mean, I'm an M&A lawyer. Like, I know this piece of it,
Right.
but I couldn't do a residential real estate transaction. I couldn't do somebody's estate plan. And to imagine doing all three of those things in the same day, I mean, that's like an incredible. Like, so I was like in awe of the lawyer, but at the same time, on the M&A side, I would have preferred probably to have been dealing with a pure M&A lawyer, because it would have made my life a little bit easier. But it doesn't mean that the person didn't know what they were doing.
Right.
It just meant that, there was a little bit of coaching from me, and again, in a very positive way, not condescending. I mean, these people are incredibly smart. They just have a varied experience, and their experience is a little bit different than mine. And so I want to, again, be a positive part of getting a deal done. And so, on different transactions, you have to kind of play different roles a little bit. And again, never in a way that is trying to be condescending or to make somebody look foolish in front of their own client. But you do still have to make sure the deal gets done, and it's got to get done in a way that's right, that protects the buyer, protects the equity investors, that protects the lender, all the money that's coming into this business. So it needs to get done in a basically traditional private equity M&A fashion. And so sometimes there's a little bit of coaching, so that the seller doesn't think they're going to be walking away like they've sold a used car on an as is, whereas basis.
Right. That is something that I have heard quite a bit, where it's important to negotiate some kind of agreement with the seller that they stay on, that they don't do a simple, sometimes you see it advertised, will stay on for 15 days or 30 days or something. That kind of a transition doesn't typically lead to a successful transition for the new owner. That it's important to have an extended stay, and maybe where there's still some skin in the game for the seller. Perhaps they get a portion of what of the purchase price later on, pending certain milestones being met on new business or increased profit margin, et cetera. Do you find those kinds of terms are more common or less common? Do you recommend those sorts of things when you're dealing with searchers?
Sure. There's a bunch of different ways and a bunch of different angles and a bunch of different thoughts around seller involvement post-closing. And I think for the most part, I think there's, having some sort of involvement in going forward doesn't necessarily mean running the company, but maybe having a seller note that's got to get paid over time, maybe having, very typical to have, leave some money in escrow so that there are no indemnity, or make sure there are no indemnity claims following the closing, that would get done or kind of, be held for 12 months, something like that. So some of the purchase price being withheld in either through the form of a note or through the form of an escrow or both. I think earnouts, like you're talking about, we need some profitability targets or additional customer targets or, revenue targets for the next year, the next 2 years. Those are workable. We can do it. I don't always recommend it because it's not, they can be kind of complicated. They can cause a little bit of a misalignment. Somebody might be, if you focus on revenue, somebody might be focused on, unprofitable revenue and that kind of thing. And so you can have a little bit of a mixed bag on whether earnouts make sense. But they certainly are a way to bridge a valuation gap. I mean, if you think about it in the COVID era, it's like, nobody really knows when this is going to go away. Right. And so if you kind of build in an earnout that says, hey, we're both going to take a little bit of this risk. If the business comes back or continues to perform the way that it's supposed to, then we're going to pay you a little bit more. And if it doesn't, then we're going to pay you a little bit less. And that's just a fair deal. And so certainly you could structure like that, but you don't have to. And that is not unique to the to a kind of COVID era. That is really at any time. If there's always a situation where we're not sure if this is the right price, or buyer thinks it's less and seller thinks it's more, and it's a little bit of, okay, well then prove it. And if you prove it out over a couple of years, then we'll pay you a little bit more money. And so that is the kind of thing that people do. But as far as like the seller staying and actually running the business or being involved day to day, I think most investors believe that the seller really shouldn't be, the face of the company anymore. So, even if they come in to the office, probably coming into the office every day is going to give the searcher a little bit of a credibility issue, because everyone around the office, if this is a business that somebody's been running for 30 years and it's their baby and they know everybody and they know everybody's kids and grandkids and, the birthdays and all this, it's kind of tough for the searcher who's coming in as a, relatively, young and less experienced, doesn't know the business as well, all of those things. I think having that person coming into the office every day as if nothing has changed, I think investors believe that that's not as good for the new CEO, and I think searchers who have been through that feel that way too. Doesn't mean it can't work. It just means that, in that situation, probably not ideal to have the person sort of stay on as co-CEO or something like that. I think that wouldn't be the norm. But certainly, staying involved and having if they're going to roll over equity, so they still own, 20% of the business or 10% of the business, that happens. Again, different investors, different searchers, I think, have different views on whether they want more of a clean break, or more of this transition where the seller keeps owning the business, and sellers feel differently. Some sellers, well, hey, if I'm not running my business, I don't want to own it either. And other sellers are like, no, this is I'm selling to the exact person I wanted. I didn't have a kid that passed the business along to. I'm selling to the exact person that I think should take my business to the next level. And I definitely want another bite at this apple, because this person's going to turn this thing, I just made, $15 million today, but I'm going to make another 15 when this person in 5 years sells it for, 100 or 200, 300 million, whatever it is, because I believe in this business and I believe in this person. And so there's definitely an attitude of some sellers that they want to, take another go at it, and they want to continue to own a piece of the business. And again, some investors think that's great. Other investors don't think that's, a perfect situation. You kind of want the seller out of there, but I think it's one of those things that gets negotiated on every deal, and different people can think about it different ways. Right.
Okay, that's very insightful. Thank you. I saw a statistic from Professor Sean Monday, who, amongst many other distinctions, is a professor at the Fuqua School. And this statistic on investors was that approximately 75% of the capital that goes into search funds and the follow-on investments come from a very small percentage of investors. And so that just tells me that so many of these deals are seeing the same investor groups and individuals over and over again. And so I'm curious to understand what the relationships are typically like between investors and lawyers. You're completely different firms, and you have your clients, and they could be clients in some cases, but I'm guessing most of the time that's not the case. I'd love to understand more about what those relationships are like, especially since you might be seeing the same people coming around over and over again on deals.
No, I think it's a great question. And so, we don't, on any particular search fund transaction, we represent the fund itself. So we don't represent the searchers, and we don't represent the investors. So for any particular search fund, it's always, we represent the fund itself. That's the entity. That's the entity, the Delaware LLC, which is almost universally how we do it. So that being said, I interact with these investors, and it is the set of investors from the slide in Professor Monday's presentation is exactly right. I'm assuming the statistic is correct. I know all of the people on that slide. I know people at all of those firms, and we don't represent them, in particular on any particular search fund. But with respect to certain investors, I've helped with fund formation work, and I've helped with, various things, and I've helped, kind of review investments that they've done into other search funds where another attorney is representing the fund itself. So I certainly can do that, have done that, have very positive, strong relationships with all the investors in the investor community. And the investors know the documents that I use. So they're not gonna, they know I'm not trying to get away with anything. I mean, frankly, on a particular search fund deal, what we'll do with the searcher is I'll go through the documents with the searcher, and I'll make sure that they understand what's in the documents. But when I send them to investors to review, we'll send them to a lead investor or two, and I'll send a red line to the investors, if they want it. Like, that's part of what I'm going to do. I want the investors to know that we're not trying to get away with anything on them, because we don't represent the human being searchers. We represent the fund. The fund's not trying to get away with anything against the investors. The fund's not trying to get away with anything against the searchers. We're just trying to make sure that the search fund deal is what the investors believe it should be and what the searcher believes it should be. We're trying to get those documents correct. And so this isn't a really highly combative situation where the searcher and the investors are like totally at odds. And so for me, it's not, I have very, very positive relationships with the investors, but a searcher is never going to think that I'm somehow on the side of the investors. I mean, I'm not like that tied in where a searcher could believe that I would do something that's more in the investor's interest than the searcher's interest. It's always going to be whatever is in the fund's interest, which again, the fund is neutral as between, how economics gets shared between investors and searchers. The fund is neutral, so that's not a position where I can't like negotiate for you, against the investors to get a higher carry or something like that. Like that's just not that's not the role of a lawyer.
Right. So that is an area where the search fund entrepreneur needs to understand what is acceptable for them and what kind of terms they're really interested in. And if I'm understanding you correctly, what your role would be is to make sure that all the documentation reflects that agreement that the searcher and therefore their fund has with the investors, and then follow on with the sellers.
Right. Yeah. No. I mean, I think when you think about it with respect to the investors, the searcher is the one who the investors know what's market. I mean, they make the market. So whatever the investors say is market is market. I mean, I'm not going to tell the investors that it's not market. It is market. But my job is to make sure that the searcher understands what's market. That if the investors are saying this is market, if I have seen or heard something different, I will say, I think maybe it's market, or maybe it's corner case, or maybe it's, I see it in 35% of deals. I don't know if that's market, but if it's 35% and it's like trending up, then yeah, okay, that's exactly right. I just want to make sure that the searchers need to have fair information, and that's not doing the right thing for the search fund. Again, for the search fund, it's important that its managers, that it's kind of people that are going to be running it, its principals, the CEOs, basically the searchers. It's important that they don't feel like they've had the wool pulled over their eyes. So I do think that is an important part of what we do, is make sure the managers know that what they're getting is a fair deal. They're not getting ripped off in any way. That to me is totally fair. That's not representing the searcher. That's just making sure that everybody agrees that this is, this is what we're doing and this is what's market. And so, there's just full information. The investors already know what's market, but we could have that conversation, and we could have that conversation as a group, and sometimes we do, and I'm happy to be a part of it and be kind of a neutral person in the middle who just sees it from all different sides. But yeah, I mean, with respect to the seller, I mean, when we're negotiating an M&A transaction, we're all aligned. I mean, everybody on our side, the searcher, the fund itself, the investors. We're all aligned, and we're all aligned to kind of get the best, kind of fair deal. Obviously, the deal's got to get done, so we can't, if we ask for ridiculous terms or things that are completely off market or unreasonable, then there's no deal, and that's not a positive thing for anybody. Everybody loses in that situation. But if the sellers are, trying to again like get away with an as is where is type deal, we just can't do it. I mean, even if the human being searchers themselves are saying, I definitely want to get this done, if it's not the right thing for the fund, and for the fund, I mean the investors and the searchers, and again, then being able to pay off its debt, so make sure it's right for the lender as well, we're not going to do the deal. It just, the searchers can't force a bad deal, but that's not going to be because of me. That's going to be because the investors aren't going to put the money in if it's a bad deal. So, I mean, again, that's the investors do drive the process to some degree, but they really do rely on the searchers, because the searchers are the ones who are doing diligence. The searchers are the ones who are, really kind of kicking the tires on the EBITDA, making sure the valuation is correct, and driving the process with the seller, making sure that the customer relationships are good, supplier relationships are good, the business sort of the prognosis is good for the future for the business. I mean, the investors really do rely on the searchers to do that, and they trust the searchers to do that. And then my job is to make sure that the paperwork confirms the diligence that's been done, and that the mechanics and the purchase price and the working capital, and that it's cash free, debt free, all those things. I mean, that's the idea. But the searcher is really the key to getting this whole thing done.
Got it. All right. Thank you very much. And Ram, I've got maybe one more question. Is there anything that you wish I had asked you, which I haven't asked you, which you think is essential for someone who is thinking about entrepreneurship through acquisition, whether a traditional model or self-funded or going through an accelerator? Is there anything that you wish I had asked? This is the floor is yours. Go ahead and let them know.
Yeah, no. I mean, I think you kind of hit on it with your question, which is ETA broadly is right for a lot of people. Traditional search funds are right for certain people. Self-funded searches are right for other people. Somebody that's more like an EIR within an accelerator model that's going to be the right fit for somebody. And for somebody else, it's building a relationship with somebody that's a little bit more long-term, like a family office where they could, buy a business, long-term hold, and kind of run it, maybe in perpetuity. So you just have to want to own and run your own business. That's got to be part of what you want. That has to be a win. If the only thing that's going to be a win is if you buy a business for $10 million and you sell it for $250 million in 3 years, if that's the only way that you're going to feel good is because you made that amount of money, don't do this. I mean, there's no guarantee on any of this. But if it's going to be a win because you are buying a business that you are going to run yourself, and you're going to put your own stamp on it, and you're going to help create jobs and improve people's livelihoods and do all of those things, and you're going to feel good at the end of the day, and kind of you control the agenda, then do it. I mean, that's the thing. There's no wrong way to get into ETA if it's right for you. But don't do it just because you think you're going to make millions and millions and millions of dollars. There's no guarantee on that, but many people do, and it's a very successful model. But you work hard. We all work hard to get these things done, and it's fun. I mean, it is more. I mean, I do like this. There's a reason why I am very focused on ETA and lower middle market private equity and independent sponsored transactions, and it's because the more the higher kind of middle market, or the more traditional kind of $1 billion transactions, I think there does end up being a little bit less of a feeling of the person. You're not necessarily interacting with the person that at the end of the day is going to be running the business. I mean, I love working with entrepreneurs in this situation, because the day after the deal closes, I now have a new client where the CEO and I have a great level of trust and that bond of having gotten through the M&A deal. And, frankly, there's tons of stuff that that we're not going to do on day one, but, there's a lot of stuff we found in diligence that we probably think should get cleaned up, and we're going to do that over time. And, hopefully we're still going to be working together in 4 or 5 years when you're ready to exit, and we're going to work on that with you too. And it's going to be a great story. So this is, I mean, I love doing it. I love coming to work every day and working with entrepreneurs.
Ram, thank you very much. I think that sums up the ETA for our students and alumni. It is it's an increasingly popular option for many of our students. And we have lots of alumni who are 5 to 10 years out of school who are considering buying a company. And you just summed up what I hear from so many of them when they reach out to us. I'd like to thank you for taking the time to connect with me today, and really appreciate your time and your energy today.
All right, it was my pleasure. Thank you, Stefan.
All right, thank you.